Welcome, everybody, to another episode of the Tech Guys Who Invest podcast, where each week we teach you how to invest wisely and safely. This week, we have our guest, David Kamara, to talk about his journey from being a full-time tech guy to a full-time real estate investor. Welcome, David.
Thank you very much. It's a pleasure to be here.
Yeah, David, thanks so much for coming on the show. We'd love to start off by just talking to you a little bit about your journey there from tech guy to full-time investor. Can you sort of walk us through how that unfolded?
Sure. I'd probably even take it a bit before the tech guy thing happened. So I came to this country as a foreign student from Sierra Leone, West Africa, and I was actually born in Ukraine. So my mother is Ukrainian, my dad is from Sierra Leone. My dad is a medical doctor, and so in Sierra Leone, my dad had a practice or a clinic, and I assisted, right? So I was one of those kids that was always in the clinic, and ended up doing a surgery with my dad at 17. It's Africa. There's not a ton of regulations, but my dad made sure I didn't get into trouble. So when I came here to the States, the thought was that I was going to go be a medical doctor, right? That was kind of the original goal, until I found out how expensive med school was. And the fact that as a foreign student, you actually, I mean, either you pay cash or it's kind of good luck. You don't have a lot of student loan debt available to you, because I guess some people may have misused the system and got their degrees and left and never paid back. In any case, when I got here, I did do the biology and chemistry for a while, and then I figured that, I mean, it's going to be a difficult kind of run. And I kind of looked around and said, well, what else am I interested in? And I was very good at math. Had never done any kind of programming back in Africa, but I was fascinated by kind of the idea of programming and technology. And this was late 90s, right? So everyone's talking about Y2K and the end of the world, with all this craziness that's going to happen when the computers get confused. So I ended up taking some computer science classes. I loved it, was really good at it. I went from community college to University of Michigan, which had still has a great computer science program, computer engineering program. So I majored in computer science and ended up working for a company in Chicago. I did have a couple offers to go to the Bay Area and work in Silicon Valley, but my wife, who I was dating at the time, was graduating a semester later, and I didn't want to be too far away, and also we were planning on getting married, and so it was going to be kind of cross country, too many trips. Plus, I think the other thing that I really cared for is I knew that I liked tech, but I also wanted to get on the business side of tech. So I wanted to be in a place where I can get a really good MBA program. Long story short, picked Chicago, don't regret it. I think it worked out great. And my first job was working for a large private business, developing systems internally for business. So that was kind of where I started. Now I'll take a pause. I know I'm rambling a little bit.
No, this is great. I mean, a lot of our listeners are in IT. A lot of our listeners happen to be engineers, and it's great to hear the progression of one of us, so to speak, who kind of finds real estate investing and loves it so much that they move towards that. So please continue.
All right, cool. Yeah, so I mean, the thing I think many listeners will relate, right? The thing that I loved about computer science and programming and tech in general is like there's just so much change, and it's so interesting. Specifically on the coding side, I mean, I think it was just very empowering to have a great idea and to be able to code it up, right? And have something execute like your logic, whatever you're thinking. So that was very interesting. Really loved that. Ended up getting married. My wife and I lived in Chicago, lived in the city, moved out to the burbs, bought our first house. And that's kind of when the real estate thing was kind of became very interesting, right? So here we are, like early 20s, and we're putting down 5% on this house, right? And now you control this large asset. And at the time, I just started reading a lot of real estate, single family investing books, and I'm like, man, this is really interesting. Like you can put down 10 grand on a place, and if it appreciates 10 grand, which was not too out of the question, right? Like you just made 100% of your money if you sell. So I went to a number of conferences back then, and I kind of like decided like, yeah, I'm going to do this. This is going to be interesting. And my wife didn't really have much opposition to it. We went to a number of conferences together. Um, Ended up buying a duplex and a threeplex a few years after that. We're looking for something that we could afford, something where we wouldn't lose our shirt, so to speak. That worked out. I self-managed that, and things were going really well. And of course, 2008 happened with the whole downturn. We bought another house not too far from where we were living. The whole downturn happened. I ended up getting my MBA from University of Chicago, which was the plan all along, and I ended up transitioning into management consulting. So that became a lot more time consuming, right? And on the management consulting side, the interesting part of that job was while it was different problems in different places and you travel and you kind of get to see different business models, I actually got to do a fair amount of tech there too. So a lot of the things we did were kind of function specific, and I ended up doing a lot of IT specific analysis and evaluation. Um, so that was pretty fun. And then we had kids, and long story short, the years went by, and we ended up moving back to Michigan, my wife and I. And it was essentially one evening, I ended up leaving the firms I worked. And then kind of the whole thing, right? How do you run an IT environment for a small business, small being 200 million to $500 million business?
And that's pretty entrepreneurial, right? I mean, I'm hearing the entrepreneurial side of you come out, which we also see with a lot of real estate investors.
Yeah, so it was definitely not the common path in a way. So transition from kind of writing code to being a program manager to being a management consultant, I think was fairly natural in that you're problem solving, right?
Right.
And it was good with the MBA side to look at the business side of things and what business models worked. In the early days, we were analyzing things like Dell, right? And Dell's warranty programs that they had on their computers. And it's like, you look at these other companies like Asus, they come in and they kill these guys because they basically design the stuff to break, and their warranties, they don't care because the stuff is inexpensive. Dell, on the other hand, was having these warranties where, I mean, they'd get a guy to your house within 24 hours and we're like, hey, Dell, yeah, this is great, but it's costing you an arm and a leg. These guys, competitors are eating your lunch. One of my partners went into Motorola and told the CEO basically that, hey, listen, if you continue doing what you're doing, you like it or not, you may not like what I have to say right now, but essentially, I'll be in here in 6 months talking to your replacement because your business model is taking you down the drain and you're not going to make it. Because we're looking at what Motorola was doing versus HTC versus Apple. The iPhone had just come out. So it was really cool technology stuff. But then at the end of the day, I ended up developing enough relationships with people that when I essentially said, do you mind what the letterhead says on the reports I write for you? They said, no, we love your work. Just, I mean, we'd work with you, whatever. So I basically said, fine, I'm hanging up my own shingle. I have a few people that I love to work with. We're going to create our own firm. And that worked out really well. So I can't really complain. So back to the real estate journey, that was going extremely well. The consulting business was booming, is booming. And then I
David, can
had
I
a
just
conversation.
interject really quickly?
Please.
I wanted to know, with all the things that are happening, it sounds like you're achieving success in this professional career that you have. The trajectory sounds great, right? You're evolving, you're progressing, you're growing, you're moving up the ladder, if you will. Where does why invest in real estate, right? I'm curious as to, if all of these things are happening, very good for you. What's the motivation to invest in real estate?
Yeah, no, and I know I was a bit long about getting there, but essentially, after I started my firm and things are going well, and we essentially, the first couple of years, I mean, from a financial perspective, I made probably double and triple what I was doing when I was employed by one of these great firms. Um, I'm still traveling, right? So I'm going to
Mhm.
clients, I'm on a plane Monday morning, I come back probably Wednesday night, Thursday night. I have a conversation with my 8-year-old daughter and she says, Dad, are you going to work tomorrow? And really what that was asking or hinting at was, am I not going to see you for the next 3 to 4 days? And so that question was really what prompted the whole, wait a second, and talk to my wife, like, what are we doing here, right? So this, I mean, the career side's great, the money's great. It's interesting. We're working on things that are in the news. We're helping big companies figure out things. It's very rewarding, but you kind of get caught up. And I mean, literally, my wife and I talked about it and said, yeah, we need to find a way to get me home. And I mean, as any traveling professional, any consultant, management consultant, any highly paid individual knows, yes, I mean, those careers are extremely intellectually challenging, rewarding, but they take away a lot of time, right? And so some people manage to balance that well, but it's kind of a struggle, right? If you have a family and you really care about being there, it's not the easiest setup. So basically, my wife and I made a conscious decision and said, we have done this single family investing. We understand the model. We agree it works, right? But we never really kind of paid enough attention to it to say, how do we scale this to a level where, I mean, so I think at that point we had about 8 units or 8 combinations of single family and duplexes and threeplexes running around. And I mean, those were cash flowing really well. So our question to ourselves was, how do we take that and go 10x or 20x or 30x, right? And how do we do that at scale where if we can get the same financial model there times 10, times 20, times 30, would that not be enough to get me home more, right? And so essentially that's kind of, that was the light bulb or the moment where we said, we need to take this more seriously, and was really the impetus for us to go and buy a multifamily property.
Love it. Love that motivation there. So, when it comes to investing in real estate, why focus on things like Class B and Class C, and not Class A or single family? What's your stance on why you focus primarily on those two?
Yeah, so I mean, really returns, right? Um, Class A is definitely, so for listeners, Class A properties are typically your more recently built properties within typically 10 years, have the most recent amenities, right? These are the places that are new construction and I mean are very attractive and very nice to live and command high rents. Um, from an investor perspective, your returns in those properties tend to be a little bit lower because they're lower risk, right? So you are going to pay for the fact that your property is a brand new property or relatively brand new. And I mean, if you live on the coast or in any large metro, you know that um, no amount of rent is going to really provide that kind of cash flow to pay off the mortgages that some of these properties provide, right? Or the kinds of valuations that they require or that they command. So for us, for my wife and I, when we started looking at properties, we basically said, I mean, we're doing this for the return. We're really trying to get me home. And for that reason, Class B, which is slightly less updated, slightly maybe older, or maybe even a 30 or 40-year construction, but recently renovated, those provide better returns because they're not as expensive on a per unit basis. And also your rents are, I mean, a little bit lower than Class A, but not tremendously lower. So your overall returns are essentially much higher. When you contrast multifamily with single family, and I again kind of started there and kind of moved on, the real issue is diversification, right? So again, it's risk. With having many tenants under one roof, you're essentially hedging and diversifying the risk that one person or two or 10 may run into tough times. And we saw that very vividly with this whole global pandemic. Um, you may be lucky to have a tenant in your property, in your single family house, that is at a good job and things are going well. And I've had that, and for the longest time, never had to really care about anything. And then that tenant moved on and did something else. Got another tenant in there. Um, for the first few months, things were going well, but then something happened and they couldn't make the payment. And then with single family, you're kind of really stuck with the whole thing, right? So that diversification is important, especially when you're starting. right? Many people, I think, have started maybe run into tough tenants in single family, which kind of made left a sour taste in their mouth in the whole industry, and then they never continued. So for that particular purpose, again, in business school, they teach you about the return and the risk, right? The alpha and the beta. With multifamily, you get that really good mix of high return and really relatively low risk as long as you have enough units. And then you kind of just diversify between location, whether that's local economy, tenants, and also operators if you're a passive investor.
David, can you talk to us a little bit about what types of markets you look at when you're looking at properties and opportunities? What types of markets are you looking in?
Sure. So if anyone has followed demographic shifts in the country and how things are progressing, I think everybody knows that a lot of the movement geographically is towards the southeast, right? A lot of movement is in that direction for various reasons. People don't like it to be super cold, right? There's some business friendly environments in the southern states. Personally, I live in Michigan, and if you look at some of the maps out there, they'll tell you Michigan is a net outflow state. But again, I feel like my advantage is that I know the local market, right? So I lived in Chicago for a long time. I lived in Michigan for a long time. So our investments are primarily Illinois, Indiana, and Michigan. Do we look at deals in the Southeast? Absolutely. But I feel like for me to go out there, I need to get a big enough deal, which is in our case, 200 units plus or somewhere thereabouts. And I think the other key thing is property management, right? So your property manager is a very key player on your team. We're very happy with who we've partnered with up here. And in fact, I think one of our differentiating factors is when you invest in the syndication, right? One of the key things that you need to know is you need to trust your operator, in this case us, but you also need to understand how capable are they at executing the business plan that they're essentially marketing to you. And having a property manager that is super experienced, manages over 5,000 units, but also is part of the management team is extremely helpful because, I mean, they're not only incentivized based on fees, they also have equity in the business. And so they make sure that the execution happens. So long story, long-winded answer. We look locally primarily. Most of our investments right now are in Michigan and Illinois. We exit some things in Indiana, but we look everywhere really.
Nice. Yeah, I love that the aspect of you talking about investing effectively in your own backyard. I want to touch on that later too, but it sounds like when it comes to passive investors, right? What advice would you have for those individuals looking to invest in syndication when it comes to finding the right operator or finding the right type of deal or syndication group, if you will? What advice do you have for people that are kind of trying to figure out which direction they should go?
Yeah, I think the number one question that they need to answer if they're indeed looking at passive and if they're indeed looking at syndications, they need to know the operator that they're investing with, right? They need to be very comfortable with who they're giving their money to. Because again, right, we're all tech people, you know that, I mean, you can make numbers, tell whatever story you want. It's very easy for an operator to tell a good story, right? It's different how they act when things go south, right? And again, having some, I mean, it could be a personal relationship. It could be, you know, some people like they want the handshake and they want to look into your eyes and they feel like they can tell. I forget what book this was, but I think there was an analysis of how good judges are at predicting the repeat offenders that they were sentencing, and they kind of benchmark judges versus a computer just based on looking at facts of what the people's history was. And I mean, the computers really knock the socks out of judges. So at the end of the day, it's very difficult to judge character. And so that's where that personal knowledge of who you're talking to, I think is important. Now, especially in this world we live in where it's all over Zoom, typically you don't really get to know the person. It's much more difficult. So I would say try to speak to investors that have invested with these folks, right? And ask them questions about their track record, right? I think those are the most important things. Secondly, I think we already kind of touched on it. the property management aspect is extremely important. A lot of operators just go with reputable names in the industry. That works very well. But again, like we have taken the additional step of saying, we want the property manager to be part of our general partner team and having them have skin in the game. Our property management often invests in the deal. They don't just get a GP share, they also put their own cash in. So I think that just kind of talks to the caliber of people that we're working with.
So David, as we kind of move through the pandemic and, people are trying to figure out how to invest or, what changes we're likely to see. And also with some of the things that are going on with the Fed and, with our, just kind of our economic climate, with lots of money printing and some people predicting inflation coming and things like that. What are some ways you're kind of looking at how to invest in the near future, maybe the next 1 to 5 years, something along those lines? How are you kind of looking at that?
Yeah, no, that's a very good question. First of all, we primarily invest for cash flow, which kind of, is a little bit different from many, right? So your returns on a syndication deal come from really two tranches, right? One tranche is your cash flow yearly, and then the other is kind of your appreciation on sale or the forced appreciation on sale. We never really started trying to become a syndication business. This whole thing is kind of by accident. Like I said, my wife and I said, how do we get me home? And so in our first, whatever, I'd say 18 months, we bought about 150 plus units just for us, right? And which kind of enabled us to be in the comfortable position we are in. So our stance is a little bit different from most in that we don't have to do deals just to do deals or to generate fees. We always put our cash into the deals we do. And the environment has changed quite significantly in the past year. So to your question, when I look at deals now, I kind of find it difficult to get to something that makes sense, or I find it difficult to justify some of these valuations. But the reality of it is that while pricing is much more expensive, significantly more expensive, the money is also significantly less expensive, right? So a lot of people are justifying paying higher valuations because they can get cheap debt. And we're closing a deal this week. It's 124 unit, and our debt is at 2.41% fixed for 35 years. We're doing a HUD loan. So
unbelievable. Huh?
Like things like that really make me very comfortable with being able to invest in something like that, right? So we have for that particular deal, we're projecting a 10-year hold. The inflation worries are definitely there, right? Because there is a lot of money that's being injected into the economy. And the Fed and everyone has essentially said, yes, while in the past recovery was extremely slow, right? The 2008 recovery was extremely slow and painful. They're not as concerned about injecting some inflation into this. From a real estate investment perspective, if you're an investor, active or passive, this is all good news for you, right? Because your debt is fixed. And when there's more money, pricing goes up. Valuations of properties go up, but also rents go up over time. So yes, probably in the next year or two, depending on where you invested, you may or may not be able to raise rent significantly. But if you're a 5-year, 7-year, 10-year investor, it's almost guaranteed that your property will be worth more in 5 to 7 years. It may not be worth more next year, but essentially, as you are able to increase rent systematically, and as you're able to run your property well, keep on improving whatever the amenities are, make it a nice place to live, you will be able to charge higher rents. And again, it's just simple math, right? Your debt is fixed while your rents over time keep going up. So, from my perspective, we're definitely buyers at this point, just, for the reasons I mentioned, right? Debt is at essentially historic lows, right? When I started buying things, which was not too long ago, I have loans at 5+%. A 2.41% interest rate on a 35-year fixed loan. That was better than I could get on refinancing my own personal residence. So it's kind of like, wow, it's free money in a way.
It's mind blowing.
Absolutely. That is, yeah, I love that you were talking about that. That money is free and you effectively, you got to do something with it at this point in time. One question for you, David. With all the experience you have from your professional life, were there any particular skills that stood out that you said, "Oh, actually, I've been using this one," or anything you garnered from your management consulting days, anything like that that you put to use as a real estate investor?
Specifically, what I was doing, I was focused on operations and operational transformations, right? And we were very technical in our practice, which was really, we had a practice called enterprise profitability, which meant we literally took a business, looked at the P&L, benchmarked each line to the best in class in that industry. So if we're looking at, again, back to our tech examples, if we're looking at computer manufacturers, IBM, Dell, Asus, Acer, whoever, we look at how much do they spend on R&D, how much do they spend on SG&A, we'll look at how much do they spend on sales specifically, how much do they spend on marketing. And then we'll look at all the costs involved, right? What are your warranty costs, which is kind of the example we talked about, manufacturing costs, shipping costs, right? All of those things, which is essentially, I mean, what you do in a real estate setting, except it's a lot fewer variables and much more simple, right? I mean, when you're looking at a building, you don't have to figure out like what your supply is doing from Asia and if it's on the water, if it's in the air and where it's coming from. This is basically, what are your rents? Can you bump them? Can you bump them without doing much? Or do you have to go do some cosmetic things or do you have to do some structural things? So that's your top line. Are there amenities you can introduce? Can you charge more for whatever, parking spots, or can you make a pool nicer, a better clubhouse so that you can rent it out? And then on the cost side, it's essentially your big items are taxes, mortgage, insurance, repair and maintenance. So from that perspective, I mean, it's extremely applicable for me, and having years of doing that in a professional setting for large businesses and complicated businesses makes this side a little bit less challenging. I'd say a lot less challenging, but also a lot of the work I was doing was for private equity buyers. And again, for those who have worked with private equity buyers, you would know that their speed and their expectations and their accountability is way different from corporate buyers, right? So these guys are buying this thing to essentially flip it, whatever the business is, or to add some value and then sell it. They have a fairly fixed duration of buy to exit cycle, which is not very dissimilar from what we're doing in the syndication business. So that discipline really kind of instilled in me what's required for this. And I mean, I feel extremely fortunate. And I mean, the model is essentially the same model. We're raising money from pools of people that want to invest, and they get a great return, and the rest is just execution.
Excellent. So I'd like to shift gears just a little bit. I think it's pretty cool that you invest with your wife, that you guys invest kind of like as a family partnership, a family business. Uh, can you talk to us a little bit about what that's like, and maybe any tips you might have for others who are considering investing with their spouse?
um, well, I mean, I think each situation is different. I was just extremely fortunate that my wife was mostly on the same page. I can't say we're always on the same page, but she's definitely, she trusted me to start it and go kind of explore. And then when things got interesting with big numbers, right, we had to sit down, have the conversation, kind of look at the pros and cons, look at the risks. And again, we've been to a number of conferences together. She is very much aware of the markets, aware of the returns, has kind of studied since we started, right, what the returns are in this asset class versus others. And again, she's been very helpful with kind of project execution, specifically on kind of renovations that we do. So when we started our own management consulting business, one of the things that we did was my wife was in charge. So I was traveling. My wife was in charge of doing all the renovations on our house, our personal residence. And she really literally knocked it out of the park. And so when that project was complete, we're like, wow, this is really nice. And then I was kind of doing the buyer's regret thing, like the buyer's remorse, like, should we have spent like this kind of cash on our personal house, or should have bought like a 40, 50, 60 unit building? And so then she was like, well, why don't we take the money out and go do that now, right? The value is higher. So I mean, essentially, it's been very good, and should ask things or questions that I wouldn't ask, right? So it's nice when you're working with someone who has a different perspective. Um, it's been nothing but great, really. I think we're pretty fortunate to have that kind of relationship, and it's worked out.
Yeah, that's
Love it.
fantastic.
Yeah, I love that. That's very good. And another thing, piggybacking off of that advice aspect, what advice would you have for investors or people who are in tech right now that are thinking about investing or want to transition to buying assets that are in that period where you were once? What would you say to them?
Yeah, my biggest advice is take action, right? Because again, like I have tons of tech people, tons of tech friends. A lot of my investors, past investors, are tech friends. Um, I mean, I talked to a buddy of mine about a deal I was working on. He's a business school friend. He has a PhD and two MBAs. I mean, super technical guy, runs massive programs for a large conglomerate, very complex systems. Um, but the guy can't make a decision, right? It's like, I mean, I walk him through the model, and I think as tech people and analytical minds, I think sometimes we tend to overanalyze things, right? It's like, well, what if this variable goes wrong? What if this variable goes wrong? What happens in this scenario? And it's like sensitivity analysis to the nth degree. And at some point, you just have to move and go do something, right? I mean, we can definitely sit here and write a thesis about the various things that can go wrong on any given assessment or any given investment. Um, you have to trust that. I mean, once you've identified your 80% of risks and have some kind of plans for them, you'll figure out the 20%, right? And I think what I see is that a number of technical people, frankly, I almost feel like in their case, education is a disadvantage, right? Because they've seen things go wrong at some of the places they work with large businesses, with large corporations and complex programs, that they're probably just a bit more risk averse than they need to be. Um, I think at the end of the day, like I mentioned, real estate is a much simpler business, right? And you can pretty much look at a spreadsheet, right? And you can add the top line and the bottom line. There's fewer variability in what we're doing. So for example, I stay away from construction, right? Why? Yeah, I'm risk averse, but I just don't know enough. And I don't pretend that I do. There are tons of people that make a killing in construction and new development, right? It's just not something I know. Why don't I like it personally? I just feel like there are many more variables that I can't control. There's permitting, there is lockdowns during COVID, for example. Um, it's just something that I don't know enough, and I just acknowledge it and say, that deal's not for me. I'm going to stick with something where day one when we close, I know what my top line rents are. I'm not projecting anything too out of the ordinary to happen, and I know what my loan is going to look like, and so I know what my bottom line is. And then if we do something smart and pay attention to the numbers, right, and stay disciplined like we've learned in the PE model, in the private equity model, then I'm pretty sure that I can deliver these returns. And that's kind of what we stick to.
Yeah, that's great. I'm really happy to hear you encourage people to take action. I agree and often give that advice as well. You have to just move forward. You have to do something, take action, and get started. It's so important, especially if you want to become financially free and not have to worry about um, not have to worry about what if I lose my job or what happens when I want to retire. I think that's great advice. So, David, we
If I
would
might just piggyback on that for a second, I
sure.
think I think the difficulty is many IT professionals are very highly paid, right? And so it's scary in a way to say, well, what if I didn't have this job, right?
Hmm.
The truth of it is, I mean, I think what I try to encourage people to do is I'm not asking anyone to quit their job today, take all their money and put it into whatever investments, right? I think you take baby steps, you gain some confidence, and whether that's active, passive, just do something, right? Because I mean, I go to a few conferences and I see the same people at some of the same conferences, and we talk and it's like, well, they haven't done anything since the last conference or the last two conferences except just read a book or read another book or listen to more podcasts or whatever. And it's like, I mean, great. The education is very meaningful and important, but at some point there's diminishing returns in education, right? There's not that one book is not going to add so much more depth to your understanding of a topic. Go buy something and you'll learn so much more because it'll be practical, it'll be hands-on, and you'll get a lot more out of it. And even if it doesn't work out for that first deal, if it's not a slam dunk, you now have the confidence that you've done it and you learn from whatever mistake happened, or it may be a slam dunk, you never know. So I really do encourage people to just go do something. Sorry,
Excellent.
interrupted you.
Call to action. No, that's perfect. I love it. So we wouldn't be the tech guys who invest if we didn't ask you a tech question, David. And we'd like to know what piece of technology is really exciting to you today, like nowadays, in this time we're in.
Sure. I think my mom says this all the time. She says, I'm so happy to be living in this period in history. Because I mean, it's like, there's so much exciting stuff happening in tech. I mean, I think artificial intelligence, machine learning, those I think are some of the really cool things that I kind of geek out at. And I live in Michigan, so there's a lot of the automotive stuff that comes out. So like self-driving cars, and like there's a lot of debate clearly about who's going to be responsible when this thing crashes and somebody gets killed. And yes, it's a very scary thing to think about, but there was a podcast or some show on NPR a while ago, and they talked about the same thing with elevators, when elevators first became a thing, and how elevators needed an operator, right? And nobody would get into an elevator when there was no operator because they're like, what is this death box? I'm not going to the 20th floor with nobody in here controlling this machine. And they actually had to, I think it was GE who had the first elevators, they had to really work on kind of a huge marketing campaign, and they had to come up with the mood music in the elevator and make it feel safe and sound safe. But I mean, in reality, right, airplanes have this technology today. Yes, there's pilots in the cockpit. It's just interesting in both the technological capability of this, but also the social adaptability or the need to make this understood and accepted, which I find really fascinating. I would say that is some of the stuff that I really follow and have fun with.
Love it. Well, David, this has been a fantastic interview. We loved your journey, where you came from, the humble beginnings to making it in the professional world. And then to say, you know what? I want to spend more time with my family and use real estate to do that vehicle. I loved your story. I love the mentality that you have, the take action. That message is huge because people in tech will overthink things. I think it's just like a natural thing. I do it. I know Adam does it too. It's just natural. So I love that piece of action. If people wanted to get in touch with you, David, how can they do that?
Our website is Cape Sierra Capital. So Cape Sierra is a nod to Sierra Leone. So it's Cape, CAPE, Sierra, SIERRA, capital.com. And while you're there, check out my free ebook. It's called The Personal Cash Flow Formula. And it's at Cape Sierra Capital /cash flow.
All right.
We'll put
Thanks
all
so
that
much,
in the
David.
show notes.
That's awesome. Yep.
I appreciate it. No, so again, just my thought there was a lot of people understand cash flow from a business perspective, right? A lot of my business school colleagues and a lot of my management consulting colleagues. I mean, we do this for a living for companies. And then when you kind of turn around and look at your personal situation, I think people don't think about it enough, right? So I thought it was my way to contribute and put something out there that hopefully makes some sense and people find interesting.
Yeah, it's awesome. And like Kevin said, we'll make sure we throw it in the show notes so people can find it. And thanks again for coming on the show. It's been great having you.
Thank you. It's been delightful. I love your show, and anyone who hasn't, needs to keep on listening because you guys have some great topics.
Thanks,
Thank
David.
you so much, David.